I'm going to turn it over to Carissa now.
All right, hello everyone. My name is Carissa, and I'll be talking a decent amount at the early stage, first couple slides here. But before I go through it, has anyone created an entity yet? Does anyone have an entity? I know you mentioned you're an LLC, yes? Yes. By next week, you will be an LLC. Is there any other entities that have been formed? Yes. LLC. I love those back there. Yes? LLC. Anyone else? You're not going to go for CCorp? S-Corp? Why ever not? Is there a reason why you guys chose LLC over a CCorp or an S? So you mentioned you do consulting work. Are you the only owner of the LLC? What that means, LLC, if people are unfamiliar with these entities, an LLC for tax purposes is a pass-through entity, which means that instead of the entity paying tax, the owners pay tax, and the income or loss gets passed out to the owners. So when you're a single member LLC, your income, your loss gets put on your personal return if you're a single member LLC, or if you're a multi-member LLC, you'll file a separate tax return and the income and loss will be passed out to the owners, okay? So a lot of people form as an LLC because another thing that it does, first of all, it's a little bit simpler when you're a single member LLC, but another thing that it does is it avoids that double taxation issue that you might have heard in a C corporation. Has anyone heard of that before? I did the math ahead of time just so I wasn't put on the spot, but let's go over this just for a second. When you are a C corporation, let's say you make $100,000 worth of profit, yeah? The federal rate for a C corporation dropped under tax reform with the new President Trump, and the highest rate is 21%. So for my example, we're going to use 21%. Let's say the entity is taxed on that profit of $100,000, yes? So that's $21,000 of tax, which leaves you with $79,000. Then, in order to get the profit out to the owners, you're taxed again. It's called a dividend. And the highest dividend rate is 20%, okay? So then you have a 20% tax on that second level. So in total, you're paying around $36,800 in taxes, and that's that double layer of taxation that we were talking about. Well, an LLC, whether you're a single member or a multi-member, it eliminates this second layer right there, okay? So really, your tax rate is the personal tax rates, whatever you are taxed at your personal level. Now, for startups, we're very, very familiar with the thought that a startup will often start out as an LLC but might switch. So the first reason you are an LLC is for tax reasons usually, because the tax may be lower, okay? Caveat with that is even though the federal rate is 21%, the federal rate dropped to 21%, your state rate is higher than your personal rate when you're a C corporation. It's about 10% if you're a C corporation, whereas if you're a personal, it's lower. So keep in mind that even though this federal rate dropped, you still have a higher Pennsylvania tax rate, which is around 10%. Okay, so taxes are one reason many people choose to be an LLC. With the new drop in the federal rate, it might not always be the best answer because the top personal rate is around 37%. Okay, and notice combined is very close to that 41% right there. And then you have that lower personal rate. The combined rate here, 21 plus 20 plus this 10 gets you almost right around 50% of taxes to an extent. And then on the personal level, the highest personal rate is 37 plus a personal Pennsylvania rate of 3. So I'm throwing all of these numbers at you just to say that the thought process when you choose your entity might not be to go towards an LLC just for taxes, but there could be a case made to do that. So far, so good? Yes?
Isn't this just taxing you 37%? Because the taxes is...
Effectively, yeah. You have around 37%. Then it jumps up to 47%. So somewhere around 50%. Yeah. but to your point, you're right. You're essentially paying 37 cents on the dollar in taxes. Yeah? So taxes is one reason. Why do entities start out as LLCs? I love it. What's your name, sir?
Aaron.
Hi, Aaron.
It's cheaper
Why is it cheaper?
because you don't have to pay to set up articles of incorporation or anything like that.
Well, if you operate as a sole proprietor, yes. That's a legal item to an extent. I'm liking this. Another reason why it might be cheaper too is, remember I mentioned if you're a sole proprietor, it's running through your personal return, so you don't need to pay someone to prepare a separate tax return. If you have two members, you have to pay someone to prepare a separate tax return, or do it yourself, for that matter. In these situations right here, a multi-member LLC, you have to file a separate tax return outside of your personal return. Another reason is, well, let me say this. Why might you choose a C corporation instead of an LLC? Yes?
Investors prefer it.
Yes, they do. And why do they prefer it? It's a good point. Do you know?
You can issue stocks, like options.
You can issue options whether or not you're an LLC. So technically, it works on both of them.
It's a hassle to claim it if you're investing in an LLC.
Hassle. Hassle is the number one. So it's easier for the venture capitalist or the investors. What happens when you file an LLC tax return, let's say you're a multi-member LLC, when you file that return, the investor who is an owner in that LLC cannot file their tax return until you've filed your return. So let's say Birchmere, Blue Tree, Draper, some of the VCs that are out there are investing in your company, and they have 50 investments. They have to wait for all 50 of those entities to have their tax returns completed before they can do their tax return, because that K-1 gives them the information that they then need to do their tax return. So it's a nuisance, it's a hassle, it's a pain in the butt. And to be quite frank, LLCs, the tax law associated with LLCs is a lot more complicated, or at least in my opinion, than a C corporation. And most of it has to do with the allocation of income and losses, which we'll get to in a little bit. Okay? The best part about being an LLC, though, is you can convert from an LLC to a C Corp with a one-page tax election. That's another reason why entities begin as an LLC and convert to a C Corp, potentially in the future if an investor demands it. It gives you that flexibility. It's harder to go in the opposite direction. There could be some tax implications if you choose to do that. So far, so good? Questions, concerns, complaints? No? Okay. So I do want to talk one thing about, even though there is the double layer of tax over here in a C corporation, many entities choose to be a C corporation anyways. Why is that? Well, in their early years, you're not making any money. As much as you think and you hope that you're going to make money, you often are not. Well, the result of that is those losses are kept inside the entity, okay? And they simply carry forward until you have future profits. One of the main things that an entity might consider being a C corporation rather than an LLC is there's a special provision in the tax law. And I don't expect anyone to remember all of the details that I'm just going to say. If you remember anything, highlight 1202, 1202, 1202. If you go to sell your business, you sell the stock of your business, and you're a C corporation. You're an individual, and you sell your stock after holding your stock for 5 years. It's 5 years, not 4 years and 11 months, 4 years and 364 days. It's 5 years. You must hold your stock for 5 years. If you sell that stock, the IRS has a rule in place, and your entity qualifies under this, and usually you guys do. There's certain service entities that do not. But if your entity qualifies under this provision, you can exclude up to $10 million in federal capital gain and pay no tax on it. That's huge. That's amazing. And if you're a C corporation and you miss out on this opportunity, you'll kick yourself down the road. Let me give you an example. Can I give you guys an example really fast? So let's say you're a C corporation and you have let's say you have 3 individual owners, and one of them, a 4th owner is CMU. 3 individual owners and the 4th one is CMU. and you sell your stock for $40 million, and you each own the entity the same, 25%, $10 million goes to each of you, right? Makes sense. The 3 individual owners gets to exclude $10 million apiece. That's $30 million. CMU doesn't really care so much because they're not for profit. So it's a little less of a deal for them, okay? But you might consider converting from an LLC to a C Corp to start that clock. Now, I'm not promoting C corporations because there's more to this analysis than that, but it's a really big deal in the startup world, and we have had clients take advantage of this. Your goal is to remember, at least after 5 years, hey, when I'm selling my business, your goal is to push for a stock deal as opposed to an asset deal. A buyer would prefer to buy your assets rather than your stock. Why is that? A buyer prefers to buy your assets because when they purchase that company for $40 million in my example, they're able to write off that $40 million over 15 years, give or take, okay? A buyer, if they were to buy their stock, the buyer can't write off that $40 million investment until they sell the stock. Just like you guys have maybe stock of IBM or Apple. You don't write off the cost of purchasing it until you go to sell your stock. So when you get into negotiations, this is something you need to consider. So long story short, if you're a C corporation, you hold your stock for 5 years, you're an individual, and you sell your stock, you can exclude up to $10 million in federal capital gain. Yeah? Did you want to? Okay. I'd like to bounce back to the LLC because the LLC seems to be the popular structure right now. Does anyone have any questions so far? Are you having fun yet? Oh, I have a question.
Case before limited to like companies of a certain size, you said there were some exclusions. Are there other limitations?
No.
Just for startups?
If you, in the earlier stages, you have to be a certain type. You have to be technology in nature, as opposed to depending upon the wherewithal of the person running the business. So if your business style is consulting, where the income and revenue is generated from the know-how of the people like that, you don't qualify. Does that make sense? Does that answer your question?
Yeah, I was also just thinking, like, can you just, like, why would this apply if I just buy stock with the listing?
The reason it wouldn't generally,
I see what
if you
you're
buy
saying.
stock in like a large company, is there's a value limitation. Most public companies or companies that are on the stock exchange, if the value at the time you acquire the stock is more than $50 million in the company, you're not eligible for the exclusion.
Okay,
So anytime you invest in a public company, they're clearly, most of them at least, are going to be well above that value. So this provision is designed for startup businesses. It's not designed for buying stock in an existing company that is a mature company.
As with anything that's put in law, it's usually to incentivize something. The IRS at the time wanted to incentivize the creation and building of C corporations. So that's why it's in the law, as opposed to you buying a stock off of the stock market. Good question. What else you got? Anything else? Okay, I'm going to bounce over to LLCs, and I'm just going to give you guys an example and ask you a question. You can tell me what your thoughts are. Let's say I am an LLC. And in the first year, I lost $100,000, which is not uncommon in the startup world. Let's say I have 2 owners, and my 2 owners own it 50-50, okay? And my 2 owners who own it 50-50, one of them put in the full $100,000 to fund that loss. Whenever I'm doing my tax return at the end of the year, and remember I said LLCs are pass-through entities, which means that they pass out the income and loss. How do I pass out that $100,000 loss? Anyone take a stab at that? Kind sir.
Is this proportional to the participation unless you state otherwise?
So you're telling me that whoever worked in the business gets the loss?
No, isn't it proportional to how much capital put in?
Oh,
You can change that based on your corporation.
so operating agreement and the articles of incorporation dictate how the loss is spread. So you're telling me you could do it however the documentation, the legal documentation allows. So you're telling me let's assume that the agreement says allocate income and losses 50-50. Okay, so let's put $50,000 here and $50,000 here. And let's say this person right here is Innovation Works. Is anyone familiar with Innovation Works? Yeah, they fund a lot of early stage companies. Okay, and gentleman back there, he did all of the work, but the legal documentation says to split it 50-50. And because he's doing all the work, he's married, and he has a wife, and she has $50,000 of W-2 income. And I've just allocated $50,000 of a loss to that person. So you would say $50,000 of loss, $50,000 worth of income, I have taxable income of 0. Anyone think that's right? Guess what? It's a trick question. The answer is no. Why is that? Well, in LLCs, we see this a lot. The issues with the tax law is, despite the fact that the agreements might say you allocate income and loss according to their ownership percentage, unfortunately, because Innovation Works, or whoever this is, let's say it's CMU, paid for this loss, technically and economically, they are supposed to get that loss. So if you weren't paying attention to the K-1s, the system or someone who's preparing it might say, okay, 50-50 ownership, you get $50,000, and then the person who was allocated $50,000 over here might say, I could shelter some of my other income with that loss. There's a couple reasons why that doesn't work. First of all, this person has no basis to deduct that loss because they did not fund the loss. If you were doing a tax return properly, or someone was to look at this appropriately to say and provide the information to the owner that they would need to use, you would say a $100,000 loss goes to this person because he is, or that entity, is funding the loss, and nothing goes to the other person. So no, you cannot use this loss to offset other sources of income. And it makes sense, right? Because economically, that person did not pay for the loss. So the person who pays for the losses gets the loss. And that's another reason why I mentioned earlier LLC tax rules are a lot more complicated because there's more to it than just ownership percentages. For a single member LLC, it's a little bit different, but the rules are that if someone else is funding your loss, technically you're still not allowed to deduct it on your personal return. And the reason for that is you're not at risk for the loss.
If I may, I want to just re-emphasize that because a lot of people don't realize that if you form an LLC and it's showing losses and you are not paying for those losses through a loan or equity, you are not going to get to take those losses, even if they show up on your tax form from that entity. So the tax law, and to your question about the agreement back there, it's not a violation of the legal document because the legal document might have a general provision that says, in Carissa's example, you allocate P&L, profit or loss, based on ownership percentage. All LLC agreements will say that. But then, if any of you have ever seen an LLC agreement, when you look a little further, you're going to see all these references to Internal Revenue Code sections. And those Internal Revenue Code sections trump that general allocation and say that you have to do exactly what Carissa said. You have to follow who paid the loss. And if that loss was paid by some third party who's not an owner, when the tax return is filed, the loss has to be allocated to somebody. So if it's funded by someone who's other than an owner, you will put 50-50 on the two tax forms. But when you get to do your personal tax return, even though that loss is on there, you can't claim it on your personal return because you didn't fund any money. So just be careful because people think early stage, LLC, losses. I'm going to use these losses. In her example, I'm married. I have a spouse earning money, I'm gonna shelter this money. It doesn't work that way unless you are economically paying for it.
On the, yes?
Basically, do you advise taking help of third-party entity to pay loss based on this example? Or
Well, yeah, I mean, if you're trying to make a go at it and survive, you'll take any money you can get, whether or not it comes from an owner or it comes from someone else, because at some point you will potentially be making money. It's just be careful with how it's presented on your personal return once you get the K-1 from the entity. Are you allowed to take those losses that are being passed out to you? And more often than not, you guys have the idea, you have the thought, you have everything to make a go at it, but you don't have the funding to make that happen. So unless you're funding the loss, whether it's via equity or a loan to the entity, you cannot deduct the loss. Good question.
By the way, not to get in the weeds too much, but keep in mind, and that's why LLCs are complicated. She is absolutely right. If one of you started a company, and for example, your parent put the money in, even though you yourself didn't put it in, because it's a family relationship, that allows you to take the loss. So there are exceptions to the exception. And LLCs are definitely more complicated. And people, partnership tax law, candidly, a lot of people, they don't understand it. They don't understand how partnership tax law works. And we see returns that are allocating losses not the way they're supposed to be allocated.
Yeah.
So in that situation you were talking about before, where a third party, not an owner, funds the loss, would it make sense in that case for them to make them an owner, sell them like one share or something for a lot of money, so that they can then claim that loss and offset other profits that they might have? And by being an owner, they can potentially get, if they get $30,000 or whatever out of $100,000,
They could do that, but keep in mind it'll complicate their tax situation because they now need to wait for a K-1. They now need to, and I'm about to go into what happens in the following year if there's a $100,000 gain. So let me keep going onto this guy right here. So to your point, yeah, you're losing money in the early years, and maybe for a little while you are, but let's say for my example purposes, let's say in the following year you have $100,000, whoa, I'm moving this. You have $100,000 worth of income, okay? And we identified that in the first year, because this IW funded it, Innovation Works funded the loss, they got a $100,000 loss. And the other partner who didn't fund it got nothing. Let's say in the following year you have $100,000 worth of income. Ownership is 50-50. How do you allocate that income in the next year? You want to take a stab? 50-50. So you're saying that this guy had a $50,000 or $100,000 loss. This guy who had no loss now has $50,000 worth of income to report on his tax return. Well, the tax law says that actually that's not the case. Because a loss was allocated to this individual, or Innovation Works in this case, the full $100,000 goes to him, them, shim, it, whoever it is. And in this situation, to drive that point home, yes, that person might be able to take a deduction on their personal return, but they now have to pick up $100,000 worth of income in the following year. So the thought process, okay, works, but keep in mind that there's other ramifications that come about it.
And to your point, if you didn't issue equity to that person, I said to you, or Carissa said, or both of us, that loss would get allocated 50-50, but I'm telling you, you can't use it on your return. In the next year, if you had $100,000 of profit, it's going to get allocated 50-50, but you're not going to pay tax on that profit because you're going to have a loss carry forward of $50,000 to show it.
See how my little
So those losses
cockeyed thing
don't
goes?
disappear. They just carry forward into the future.
Yes.
Is money invested before any formation treated differently?
Oftentimes, that's a great question. Oftentimes, it's not uncommon to see a founder or the people who are trying to make a go at the business invest money ahead of time. It could be done a couple ways. If you've deducted on your personal return via maybe a Schedule C or single member, like a sole proprietor, like he had mentioned earlier, it's already been deducted. It is what it is. The question is, should it have been deducted? And I'm going to go. Okay. If you haven't done anything, oftentimes what we see that being done is either one of two things: a loan from the entity. So the entity is able to include the expense on its financial statements. Whether or not it could take a deduction is something we'll talk about in a moment. Or it's your contribution for equity, okay? More often than not, investors don't like to see loans to owners on their balance sheet. So we don't often see that, but they might start out as a loan and then convert to equity later. So you can deduct it inside the entity even before the entity is formed. You're kind of just pushing it into the entity from after the fact, okay? So want to talk about related to entity formation and everything that you have to think about when you form an entity, an 83B election. So the first code section I mentioned was 1202. You wrote that down, you're going to remember that. The second code section, and I promise I'm not going to be using very many more, is 83B. Has anyone heard of an 83B election? Yes. What you got? What's your name, sir?
Right.
Brad?
Yeah.
Thanks, Brad. So an
It's like something that your tax basis is later.
Yeah, there's a then and a now involved in it, and that's pretty much the crux of it. So do you mind if I explain? Yeah. So an 83B election is an election that you make 30 days after getting your units or shares. This is for a C corporation or an LLC, okay? And why would you make an 83B election? Well, you make an 83B election when your shares vest or your units vest over a period of time. What I mean by vesting is you get ownership of these units, but you get them over time. And why might you do that? Maybe an investor like Innovation Works wants to keep you there. They don't want you getting your shares up front and then saying, peace out, Girl Scout. Like, they want you to stick around. So they restrict your shares and you get them over time. So let me give you an example. Let's say you get 300,000 shares and you get 100 every year. So in year 3, you'll be fully vested. So far, so good? If you have, let's say every year your shares vest. So in year 1, you get 100,000 shares. Year 2, another 100. Year 3. The IRS has a rule that says when you get something of value, you are required to pay tax on it. So let me give you an example if you do not file your 83B election. Year 1, the entity is worth nothing. As much as you guys think it's worth $1 million, no one's going to pay you $1 million for your entity yet, right? So when you got those 100,000 shares, the value is nothing, so you pay no income tax, okay? Year 2, you're starting to kick butt, you're starting to take names. Maybe you had a VC, a venture capitalist or a private equity firm, put some money into your entity. Now when you get those shares, the value, let's say, is, just to emphasize my example, $1 million, $1 million. Without an 83B election, you are required to pick up $1 million of ordinary income and pay at ordinary rates, okay? Let's say in year 3, the value increases again, and it's worth $2 million. So you have another $2 million of income. My example is grossly overstated, but just bear with me. So now you've paid tax in year 2 and year 3 without any cash to pay for it because you haven't sold your stock, right? That's one issue with not making an 83B election. What an 83B election does is it tells the government that you're electing to pay tax now on all 300,000 shares when the value is nothing. So you have no taxable income, essentially, whenever you're electing to pay tax now on shares that have not vested. What you've just done is eliminated a cash flow issue because you're not paying tax on $1 million and $2 million every time it vests. Another issue is you have to assess the value every time it vests. You have to think about what is the value of those shares. Maybe the value is zero still. You owe too much money. Your liabilities exceed your assets, but you still have to go through that assessment. Yeah? There's one other thing that helps you when you make an 83B election. These items right here are taxed at ordinary rates. I mentioned that a little bit earlier. Ordinary rates tend to be higher than capital gain rates. Yes? Top ordinary rate is around 37%. Capital gain rates are 20%, top capital gain rates. So 17% difference. If you were to not make an 83B election, you're paying ordinary rates. If you were to make an 83B election and the value of your shares when you go to sell, let's say right in this time frame right here, and you sell it for $3 million. It's hard to do this left-handed going on there. If you made your 83B election, you've just now converted all appreciation to that $3 million to capital gains rates. Right? So you're now paying the lower of the two, the 20% on the full $3 million when you sell that, as opposed to some portion of it at ordinary rates. I'm not going to go into the math, but suffice to say, an 83B election is a no-brainer. Why am I even talking about this? Well, you have 30 days from the date that you get your shares to file this election. If your attorney who's working with you to form this entity, if they don't mention 83B, smack them. Hire someone else, because 83B is a big deal in the startup world, okay? And it only matters if they're vesting. It must be made 30 days after you get your units or shares, and a signed copy of the election needs to be attached to the entity's tax return, okay? So when you send it to the IRS, make sure you keep a copy for yourself. Sir?
In the case where you sell them for $3 million, is that only if you sell all 100,000, or can you sell?
You could sell them pieces.
And you still get that lower rate?
Yes.
Okay.
Yes. My example was just super simplistic to say you're selling all of them. But yes, you can sell pieces of them. You could do however you want. Anything else? Good. Yes.
If there were a CCorp after 5 years, you wouldn't get taxed or not?
For federal income taxes and you sold for $10 million, you'd have no capital gains. If you sell your stock, you're an individual, and you held your stock for 5 years. It's awesome. So yeah, that drives the point home too. Yes? Okay. I think that's all I have on this page. I'm going to let, you guys are sick of me, right? I'm going to come over here.
Carissa, can I ask one quick question?
Of course.
I missed this before I came in, but why would an LLC elect to be an S?
An S corporation is a pass-through entity similar to an LLC. The election to be an S corporation eliminates the local income tax on the profit. More often than not, we do not see S corporations in this world. And there's another layer of tax that's eliminated, the Social Security on it. There's a calculation you can go through, but more often than not, we don't see S corporations in your world. Why is that? It's restrictive on who can own the entity. If you're looking for funding from a venture capitalist or something, they often cannot own an S corporation. A corporation, it limits the type of owners. Another reason is distributions, money to get out to the owners needs to be pro rata. There's a lot more stipulations associated with an S corporation than there are with an LLC.
Would this be a good route for a single owner LLC?
Sometimes it can be. You would have to incorporate and then make an S election. What I would invite you to do is, we could talk about this after the fact, because there's more to it than just making an election. There's good and bad that comes with it.
Can I just add one thing to that? If you are an LLC and you're the sole owner, to me, if you were going to elect to be an S corporation, it would be with the idea that you're not seeking capital, because if you're seeking capital, S corp is probably not the right answer for you. from a tax perspective, as an S corporation, the owner will likely pay overall less taxes than the owner would pay as an LLC, as Carissa mentioned, and I would just generally say that's about 4%. So if you had $100,000 of profit, as an LLC, a single member LLC, you might pay another $4,000 of tax. Your analogy is simply to compare how much is somebody going to charge you to do an S corporation tax return versus the incremental taxes you're going to pay as an LLC. Because as a single member LLC, you don't have to file a separate return. It's just on your personal tax return. So the trade-off between the two is the incremental taxes as an LLC versus the extra administrative cost of being an S corporation. And once your profit, if you're making a lot of money, you will quickly get to the point where it makes sense to pay a tax preparer to do an S corp return because the taxes you'll save will exceed that cost. In fact, just this morning, we sent an election to one of our clients to switch to S corp status effective January 1, 19.
Two other things, though, administratively. As an owner, you would have to set up payroll if you're an S corporation. So that's an additional cost that you might not think of, because if you're a single member LLC, you don't have to you don't get paid through payroll. And then another thing is when you file, if you're an S corporation and you're not getting investors or anything like that, as you grow, that's where it makes more sense. But it's an easy election to make in the future.
Well, that was a good lead-in. So I'm Megan, for anybody that came in after we got started. Payroll is probably one of the things that we see the most issues with when it comes to doing someone's tax return. And there's a couple reasons why. I guess as far as the CCorp goes, which it's kind of simple. I mean, you've all probably had jobs before. You all get a W-2, you've got paychecks, whatever. That's a C corporation. So you're getting paid just like any other employee when you're an owner. If you're an LLC, it's a little different. So with an LLC, as Carissa mentioned, you get something that's called a K-1. And on your K-1, there's a little box listed that says guaranteed payments. So when you're an owner in an LLC, you're not getting a W-2, you're not getting a paycheck every week or whatever. You're getting something called a guaranteed payment, which is gross of tax. So if you're looking at your paycheck, typically you see all the taxes taken out. That's for a W-2. So when you're an owner in an LLC, that's not happening. The company isn't withholding on your behalf. And I think that's probably one of the biggest things we see when it comes to LLC owners is that they either include themselves in payroll and get W-2s and have the company withhold, or they don't pay themselves at all, or they don't know how to pay themselves. So I think one of the things that's important to keep in mind if you're an LLC is how are you getting paid? If you're taking money out of the company, that needs to be a thing you think about. So, okay, I took $10,000 out this year. Do I have to pay taxes on that? Well, yeah, but you're responsible for both the employer piece and the employee piece. And that's something that, you know, when you're tax planning, you're saying, okay, so if I have $100,000 that I've taken out at the end of the year, do I need to make estimates? Do I need to pay anything on that? And the answer is probably yes. So as far as, you know, an owner of an LLC, you know, you're considered self-employed, so you're paying the employer piece and the employee piece on that end. Another issue, and I think it's probably maybe even a bigger issue that we see, is the difference between an employee and an independent contractor. Yes?
I just went through this conversation yesterday with my lawyer about whether to be an independent contractor or consultants to pay myself and my co-founder. Talk about the difference between like employee, consultant, independent contractor.
You're an owner of the, or you're going to be an owner of the LLC, right?
Yes.
Okay, so you would be getting guaranteed payments. I'm not sure if the other person, are they also an owner?
She's also an owner.
Okay.
And then it's 65-35. And we're taking a salary this year. And our lawyer suggested consulting contracts.
You can have, if you want to have a legal document as a consulting contract, that's fine. But what Megan said is absolutely true. If you are an owner of an LLC, you do not get a W-2. you do not get a 1099. The tax return that the LLC files will give you a form and your other owner a form. On that form, there is a line that will report the compensation that you get. That's the only place it gets reported, and then it gets reported on your personal return. The issue is just simply, you have to pay your own taxes quarterly. You don't have withholdings. And it's a pain, and what happens is sometimes with new companies and new founders, they're not used to having to do that, so they're not disciplined in setting aside the money. And then all of a sudden, they file their tax return, and it's like, wow, I owe all these taxes because I didn't pay them in quarterly. And I'm not implying that's what you would do, but we've seen that before. That's what happens. Because there's a certain discipline that you have to set the money aside and pay it quarterly. But whether there's a legal document, I think, is a question between you and your attorney, but I want to make sure you understand that you're not getting a W-2 and you're not getting a 1099.
Usually consultants get 1099s, and that may be what he's thinking, but from a tax compliance perspective, if you're an owner and getting a salary, it goes via a K-1, not a 1099 and not a W-2. So the end result, though, is the same if you're treated like on a 1099 versus a K-1. You pay your taxes quarterly based on the income, the cash you've received.
You're still responsible for withholding for yourself, I guess, in either situation.
Mm-hmm.
That makes sense. So, sure. So I think the biggest issue between employees and independent contractors is, well, is it an employee or is it an independent contractor? Does anybody know the difference? Of whether you control where, when, how you work? Perfect.
Yes.
So
Love it.
when you're trying to decide if someone is an employee or an independent contractor, as she said, are you in control of them? Are you setting their schedule? Do they have to be at your office every day from 9 to 5 working on this project? Are they using their own tools or are they bringing their own things? Do they offer themselves out to do business for other people? If I was an independent contractor, am I working for her and Aaron in the back and anyone else in the room? Interns are somewhere where we see a lot of times where they're classified as independent contractors when really they're an employee. I mean, they wouldn't know what they're doing unless you were telling them and training them and teaching them what you know. That's why they're there. A lot of times we don't see interns put on the books as employees, though, because they might otherwise not have payroll. So to set up payroll for one person might be, a much. But at the same time, technically, that's what they should be doing. So that's kind of where we see some issues in that front. So if you are an independent contractor, as Bill kind of alluded to, you get something called a 1099. So as a company, if you pay someone $600 or more, at the end of the year, you would issue them what's called a 1099 miscellaneous form. And on that form, it would be the gross amount. So if you paid someone $1,000 for legal fees, you would issue that person a 1099 miscellaneous for legal fees of the gross amount. And then they take that, and they're responsible for including that in their income and paying the taxes on it. I think something new that not a lot of people, I think, have really not grasped the concept of yet, but have adopted, is that last year, at the beginning of 2018, PA actually put into law a new rule that says that if you have an independent contractor, say they live in Georgia, but they come to PA to do a service for you, they help you design a website or something like that, and they're on your premises. So technically, that person is a non-resident of PA. Will they file a PA tax return? Probably not. So PA kind of, figured that out and said, okay, well, from now on, if someone is coming out of state to your business to do work for you, you're responsible for withholding from their check 3.07%, which is the PA resident rate. So that's something to keep in mind, and if you're doing business with people that are out of state. That's all as far as 1099s. I think another point would be, so outsourcing payroll, we absolutely 100% encourage you to outsource your payroll. There's plenty of payroll providers. I think a lot of the time we get the question of, well, should I use QuickBooks? You can use QuickBooks. We don't particularly like QuickBooks, and the reason for that is the fact that, a lot of these bigger companies like ADP and Paychex and things like that, they're in tune with the state and local complexities where QuickBooks isn't. When you're using QuickBooks, you know, it's an online platform. There's not, I mean, there may be a person there that you can call and ask for help, but as far as the local withholdings, I mean, just in PA we have, or in Pittsburgh, 3% and 1%. So just for QuickBooks to know that, it's not, you're not gonna get the same result if you were using like a, I guess, more established payroll provider. But we would recommend that you outsource your payroll. If you can, outsource it. Another item as far as payroll goes would be what you need to obtain from employees and contractors. So when you hire someone, there's something called an I-9, which you probably all have filled out at some point. It's basically just your right to work in the United States. It's just your name, your address, your EIN. Here I can work. If you're a contractor and you get something called a W-9 that you fill out instead, and it's basically the same thing, name, EIN or social security number, and then address. You kind of just keep those on file. And the thing that's important with the W-9 is the fact that you could hire a contractor in January and never see them again after that. So come the next January when you have to issue them a 1099, you might not have their name, their address, their EIN, any of that. So to try to track that person down can become very difficult. So we usually advise people to, before you ever pay somebody, have them fill that out, especially if you know you're going to pay them more than $600.
Even if you're not.
Or, yeah, even if you're not going to pay them. One thing to keep in mind is that 1099 miscellaneouses don't get issued to people that are foreign. So you have to be doing work, you know, in the United States. If it's a foreign contractor, there's a form called a W-8 EEN that would kind of just say, you know, I'm exempt from 1099 miscellaneous reporting. And you would want to get that and keep that on file as well. I guess other things would just keep in mind, don't pay anybody before you actually have a system in place. You know, I know there's people out there that say, well, I need this now, I need this now, but if they're really truly an employee and you don't have payroll set up, you're just going to cause yourself more headaches down the road trying to backtrack. And a lot of the times, even if you do, you know, say you hire ADP to do your payroll taxes, they may not go back to fix something.
They will not.
Because, you know, it's not their fault. They don't want the liability of fixing your mistakes in the past. Like, if you engage them, it's from then forward. So that's something to keep in mind, and it's better to do it right the first time, which is what our presentation is called. So that's what usually we do. I think that's it.
Okay.
Payroll.
Yeah. Sir, can I ask one question? We're getting a little close on time. Are you guys okay with hanging out? And if you have to leave, by all means, but maybe a little bit after the 12:30 time frame. You guys have been asking such good questions, but you guys can leave as you go, but we'll stick around and we'll keep going if you have any questions. And our contact information is in the back, but go ahead.
The contractor earns less than $600, do they not have to file any of these?
They should pick up the income on their personal return, but you're not required to issue a 1099 to them. Good question.
If you don't have payroll, if they're truly independent contractors and they meet that definition, then no, you don't need payroll. Unless you're a CCorp and then you're paying yourself, then yes. But no, if you're an LLC and you're taking a guaranteed payment and just have contractors, then no.
Yeah.
If you're going to be spending some money on a business, but nowhere close to the $100,000 mark, maybe closer to the thousands, is it worth it to even set up an LLC? I mean, when you're looking at the smaller expenditures of just getting started, you said that some people just spend.
I'd like to comment on that. The reason, if you don't have other owners and it's just you, it's very simple to set up an LLC. It costs next to nothing. If I was in your shoes and you were asking my advice, the reason to do it is for liability protection. We're not attorneys, but the reason you set up an entity first and foremost is to insulate your personal affairs from the activities of the business. So you don't want somebody being able to access any assets that you might otherwise have personally. Without that legal entity in place, whatever you are, whatever you own is exposed to creditors of the business.
Can I add?
That's why you set it up.
So sorry. can I add one more thing to that? Oftentimes, expenses in the early stages are not actually deductible. There's a rule in the IRS that the IRS says that startup expenditures until you begin business in the eyes of the IRS are not deductible, with a couple of exceptions, which we'll talk about, and research and development being the key. One, but usually they are not deductible to begin with. And when we inherit tax returns and we see losses put on the return and passed out, they really should not have been put on the return and passed out because they were not deductible. If you're interested in the code section, it's 195. You can read up. I noticed you guys might end up leaving in a few moments. So I would be cautious of taking deductions in the early stages, even if it's on your personal return or the entity's return. Even if you do have an LLC set up, you may or may not be able to take those deductions. Okay. Do you mind if I go to the next slide? Cool beans. Are you doing this or am I doing this?
No, you are, but
Okay.
hanging out.
All right, sales tax. Sales tax, I'm not going to spend too much time on this, but I do want to let you guys know. There's been a lot of changes in the sales tax world with the Wayfair case. You guys may be aware of the online retailer who was selling into South Dakota. I'm not going to go into that, but what I want you guys to take away from this slide is that do not make your first sale until you have determined whether or not you're required to collect and remit sales taxes. Okay? Sales taxes are not something to mess with, and where you often see the issues coming to the forefront would be when you guys go through due diligence to sell your business in the future. Oftentimes that puts a stopper in the deal, or potentially it could lower your sales price whenever you go to sell your business in the future. So sales tax is something you do not want to ignore. Without knowing what your businesses are, I'm not going to go too much further, but before you bill your customer, do your homework, make sure you have something in place, and sales tax audits are not uncommon. So that's what I wanted to add about that slide. Okay.
So, I mean, the next slide is just accounting in general. Just some things to think about as you guys, start your businesses or, try to get ideas together. So who will be keeping your records? There's a trade-off between, you doing it and paying somebody else to do it. Your time is probably much better spent working on the business, like getting things together, getting things going, than sitting there and entering transactions into a QuickBooks file or something like that. So we usually recommend finding a bookkeeper. If you can and you can afford it, get a bookkeeper. It doesn't cost as much as you might think because they all have different, plans and packages and things like that. So based on, your level of transactions, it might not really be that much. And it'll save you come tax time when your accountants have to untangle everything because, for the most part, I'm sure most of you aren't accountants. You don't know the debits and the credits like an accountant would or, the tax preparer. So you're going to save money somewhere. So it might as well be, when it comes to be tax time. So a lot of the times we get the question of, is Excel enough in the first year? And it could be. If you do a good job at keeping things categorized, if you have your expenses listed with, these are travel, meals, utilities, things like that, that's what your accountant is going to be looking for when they go to do your tax return. So you might be able to, if you don't have a lot going on, sure, put it in, Excel. But at the same time, try to think, okay, how can I make this information digestible to somebody else that's going to be looking at it? Because you might know what it means, but we might not. And then the last point on here I wanted to make is just, are you using an accounting software? QuickBooks is probably the most used software that we see in our firm. There's an online application. It's super easy. If you can get to that point where you can afford to, pay for, the software package, there's really no downfall of having it. One thing that's nice is that you have financials on demand. So if somebody wants to invest in your company, you don't have to say, okay, hold on, I need 2 weeks to get the books together. They're there. You just, print out a balance sheet or print out a P&L and it's done. And that goes along with getting a bookkeeper. Having somebody that's updating things and keeping things current as you move along rather than kind of waiting until the last minute or waiting until somebody needs something. So it's always, our philosophy to do it as you go rather than try to hurry up and do it later.
Okay. No. Next slide is early stage issues. Whenever you're setting up your payroll, you're going to have to fill out the PA 100, which is an online one-stop shop one-stop shopping form that'll get you your account numbers. Your attorney will not do this, but you only want to do it once you have payroll. You do not want to do this ahead of time, because then you'll be required to file zero balance returns, the payroll returns that I'm talking about in Pennsylvania, okay? Another thing that you might want to do is make sure to keep all documentation regarding your registrations. The IRS will send you welcome letters. Pennsylvania will send you welcome letters. All of your legal information, your formation documentation. I know that sounds oxymoronic, but you'd be surprised how many times people have to go digging and refinding these things. Convertible debt. Convertible debt is something common in the startup world. And what that means is an individual or an entity will loan you money with the thought process that as you grow, there's a date where that debt will convert to equity, and they'll get the value of that equity at a discounted rate in the future. What people don't realize is interest accrues on that loan. Whether or not that interest is being paid in cash, it still accrues, and a calculation needs to be done every year, and a form needs to be given to the person who loaned the money in. For example, let's say they loan in $100,000, the annual rate is 8%, and they loaned it in January, so they have $8,000 worth of interest that accrued. The person who loaned the money has $8,000 worth of interest to pick up, even though they have interest income on their personal return or their entity return, even though they didn't get the cash. This is something we see missed a lot. All you have to remember is that if you have convertible notes, you need to assess whether or not a 1099 OID needs to be issued to them showing the interest income. Why do you care? Your mom and dad might be giving you money, and they're not a savvy investor. They don't do this often. They may have interest income that they're not expecting, and they might kick your butt down the road. So make sure that the investor is aware that there will be interest income if they give you convertible notes, okay? Stock options, what I want to mention here is that you can have stock options, and this could be a way to incentivize your employees in the future. This could be for a CCorp or an LLC, okay? We already talked about when business began a little bit. Business begins, and some deductions are not deductible, with the exception of research and development and a couple other items in the earlier years. So be careful when you're preparing these returns whether or not you can deduct expenses, okay? Next slide. The next couple slides, I'm going to talk about at a high level and just give you a little bit of background information. There's a website on here that you can go to for more information, but there are 3 tax credits that mean a lot to you in this startup world. One of the tax credits that you see oftentimes, especially when you grow, are the Keystone Innovation Zone credit. The Keystone Innovation Zone credit is a Pennsylvania credit that is based on an increase year over year in your revenue, okay? What do you have to do to get this credit? Well, first of all, you need to be located inside of one of the zones. And there are 2 zones in Pittsburgh, Greater Oakland and the Pittsburgh Central. You can go online and there's an interactive map and there's a listing of what's inside the zone and what's outside the zone. All you have to remember is, number 1, when your business is in the zone, you might decide to move into the zone if you're not already in the zone. And you need to apply for this credit once you have 2 years worth of revenue. Okay? Yes?
Some of the advice I got is it doesn't matter to make myself officially into one of the zones until we're a year with revenue. Or like, that I don't necessarily need to care initially, but.
You might. You can have a 0 base year. So for example, if you locate yourself in the zone and in the next year you have like $200,000 worth of revenue, just because you didn't have revenue in that first year, that actually makes the spread better because the credit's based on an increase year over year, remember? So now you have 200,000 minus 0 as opposed to a smaller spread. So you can locate in the zone, but you might consider not doing it because the cost of renting inside the zone is not what you want to pay.
Believe it or not, if you, in that example that she gave, where you start at 0 and then you get to 200,000, your tax credit can be $100,000. That is cash. You can sell that credit to someone else at a discount, and that is true cash coming into your business.
And it's basically what you were doing anyways. There's a ready market out there for it. You could sell it for 80 to 90 cents on the dollar. So to answer that question, I don't think there's not an incentive to locate yourself inside the zone.
It's a complicated question that may or may not fit with people. In an accelerator, I'll be located in one of these zones. Until I get to an accelerator, I'm not, because I don't want to pay rent to be somewhere. If I am off and on in accelerators, does that affect my location?
It can. It's where your business is operating, and you have to prove to the Department of Community and Economic Development that you're operating out of the zone. The goal of this credit is to incentivize certain areas that may be a little bit more depressed than others potentially. So you have to prove to them, and you would have a little bit more of a challenge to prove to them. If you'd like, shoot me an email, and I can get you some contact information for someone to talk to on that. Is that okay?
That'd be great, thank you.
Okay. Bill's right, this credit could be sold for cash. There's a very ready market out there, but this is a Pennsylvania credit only, and it can be sold for cash, okay? The next credit is the Research and Development Tax Credit. This is a federal credit and a state credit. This federal credit is a credit that's based on your R&D expenditures, and there's 3 categories that qualify for the R&D expenditures for the credit. Wages, if you're paying someone to do research and development for the proportion of time spent doing R&D. So you pay someone $100,000 and they spend 80% of their time doing R&D, $80,000 qualifies, okay? The second category is independent contractors. This is a little bit more straightforward. You're paying someone to develop the software. You're paying someone to develop your product. Those qualify, albeit at a little bit of a lower rate. The third category is supplies consumed in the R&D process. So this is more for someone who has a physical product that they're developing. Test tubes, chemicals, scrap, discard, that kind of thing qualifies for the credit. Yes?
Equipment for that employee, like chairs, desks?
No, and the reason why is it's not consumed in the R&D process. I love that you asked that question because that is one of the main questions we get. Those types of items are capitalized and depreciated over a period of time. They do not qualify for the credit. Another reason is too that you're not just using it for R&D. Like a computer, you might be using it for administrative, bookkeeping, emails, all of that different piece. It doesn't qualify.
The second question I have is to follow on this. Are these time-based, so only the first 5 years of my company? Or
No.
are they?
You can have a massively developed entity that's been around for 35, 40, 50 years. We have a couple clients that are third generation, second generation businesses that are still getting this R&D credit. So this is a federal credit, and it's calculated as part of the entity's tax return. 3 categories: wages, supplies, independent contractors qualify for the federal credit. There's also a way the IRS realized that startups weren't getting to use this tax credit because they weren't making money. Therefore, they weren't owing taxes because you're in a loss situation. The IRS now allows you to use some of this federal R&D credit to offset future payroll taxes. This is amazing because it gives you a chance to utilize this credit sooner than you otherwise would have, and it's another way to get cash in your pockets, okay? Pennsylvania also has a credit for our research and development. This credit, similar to the KIZ, is based on an increase year over year in research and development expenditures. So you need to have 2 years worth of expenditures in order to qualify for this credit. We talked about the deadline on here, and this credit can also be sold for cash, which is more importantly what you guys care about. Bill mentioned earlier that you could sell the KIZ credit for cash at around 80 to 90 cents on the dollar. The Pennsylvania credit you can sell for cash as well, around the same margin. You need 2 years, however, to qualify for this credit, okay? All right, questions, concerns, complaints?
Every early stage company involved in technology absolutely has
Is getting
R&D.
this.
It's stunning, and the government even would comment on this. How many companies across America have R&D credits and are not claiming them? Because people just don't understand the rules. So we see this all the time. And you've already spent the money. It's just a gift from the government. You're not having to spend more money to get the credit. You've already spent the money.
It's free money, essentially. You might as well take advantage of it. And it means a lot in your world. It's very important, so don't miss out on it. The last one I'm not going to spend too much time on, the job creation tax credit, because you're a couple years away from this. This is a credit that's based on an increase in the creation of jobs inside Pennsylvania, inside the Commonwealth. Here's how it works. You let Pennsylvania know that you plan on hiring 10 people over the next 3 years. Every year you report back to them and you let them know how many people you've hired. Let's say in the first year you hired 3 people. Pennsylvania says, way to go. Here's a $1,000 credit for every 1 person you hired. Now, there's certain qualifications and application process that you have to go through. You have to submit it online. You have to do budgets and all this kind of stuff to support that you have the ability to support additional employees. But it's free money, and it's a Pennsylvania tax credit. This is a credit that once you are a certain number of years old, you cannot get this credit, okay? But this credit cannot be sold for cash. Unlike the Pennsylvania R&D credit and the Pennsylvania KIZ credit, those credits can be sold for cash, but this one cannot. It'll simply carry forward until you owe Pennsylvania income taxes, okay? That being said, ladies, gents, that's what we have. I know we went over a little bit, but you guys asked such great questions throughout the presentation, so we kind of bumped it back. Between the 3 of us, we've been at it for quite some time. As you go through and you ask questions and you learn, you'll find that you can always find ways to save taxes, but the problem is, though, is it doesn't make sense economically. Bill has a lot of experience in this, but when you're making decisions, it often doesn't make sense to think taxes first, economics first. Does it make sense to spend this money? I get a tax deduction, great, but you want to make sure that you're spending your money appropriately. At the same time, you want to make sure that the money that you're spending is getting you the best benefit. So research and development credits, KIZ credits, all of these different things come into play. And then another thing that we are very sticklers on, you want to maximize your tax deductions, but you want to sleep well at night. We are your advocate, but you're not out there to bend the rules. We want you to make sure that you guys sleep well at night. You know what you're doing and you understand and you're comfortable with the positions that you're taking. So keep that in mind as you're trying to say, I want to take this deduction now. Well, is it right to take this deduction now? Okay. Bill, any other thoughts?
I just wanted to add one final thought. First of all, I want to thank you for coming on behalf of all 3 of us and for staying for that matter. It'll probably never happen, but we would love to do this over 2 hours. Because honestly, we think we have a lot of value that we can share for you. And I'm sorry, I'm not one to just tell you something and within that there's 3 terms that you don't even understand what they mean. It's one thing to tell you something, it's another thing to explain it and to try to explain what it means. It is very difficult. And you guys, you're great. Every time we come here, people always ask lots of questions. So I apologize if we've kept you over, which we have. And maybe we just need to cut out some of the material. But we take great pride in what we're sharing. And there's a lot of value. You may not realize it, but there's a lot of value in what we've provided. But it's really hard to do it in an hour. So I don't know, Allison, if we'll ever have an opportunity, but when you have more time, you can explain what are you trying to say. And it's one thing to say a rule, it's another thing to try to explain what it means. So thank you all for coming and thank you for staying.
Yeah, thank you for your time.